Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So recently some of you asked me if I can look into some of the FTSE 100 companies, so companies based in the UK, other than the ones that I own already in my portfolio. So as you know, I do have, oh by the way, before we move on, the portfolio is now crossed £63,000 for the first time, I think, this year. I think yesterday it did it, and then it went back down a little bit, and then it went back up again. So there you have it, £63,000. But let's have a look. So some of the companies that I own that are in the FTSE 100 include, okay, so RB, Rio Tinto, Seagro, and Unilever. Okay, so I've got 4 companies from the United Kingdom, and I do like them. I genuinely think I want to grow these companies to at least 5% or more each in my portfolio, because remember, I don't have to pay any dividends, taxes. I don't have to deal with the FX impact and all of this stuff for the UK based companies. So I would love to own maybe about 20% or more of my overall portfolio from the UK. I do love the US kind of stocks, but some of them obviously right now are not doing great. But the S&P 500 is down quite 20% for this year. For the FTSE, actually, I'm not sure how much is actually down. In fact, I'm going to check that now. Wow, this is interesting. So the FTSE 100 index actually was up 1 year. So if you look at from 5th of January 2022 to right now where we are, which is the 5th of January 2023, is actually up. That's amazing. I actually didn't know that. I haven't paid much attention to the FTSE 100, because the thing is, the issue with the FTSE 100 is there's so many companies that deal with, a lot of them pay some good dividends, okay? I like companies like AstraZeneca and so on. But some of these companies in here are like old companies that pay, like Diageo's and the alcohol companies, the oil companies and so on. So or financials, they and obviously some REITs as well. So they're not really like, and quite a lot of them are very, very small companies. So majority of these I think the biggest one is, I think, AstraZeneca or Unilever, one of them anyway. So yeah, so that is, so what we do today is we're going to look at 5 different companies from this list of these companies that are Sharia compliant, that I do not own in my portfolio. I own 5. And one of these 5 I'm actually considering adding to my portfolio. So let's get started. So we're just looking at the company market cap, moat, price, dividend yield, payout ratio, dividend streak, whether the dividend is stable or not, profit margin, free cash flow in pounds if we can find it, total return in the base last 10 years, and then the forecast, okay, the annual earnings growth for a year to 3, so 1 year to 3 years basically, and simply Wall Street valuation and their fair valued. Okay, right? It is quite difficult, by the way, to find information about these companies, which is like, there's not that many websites that are free that have a lot of information about these companies. But anyway, let's get started. So the first company we're looking at is Auto Trader Group. This company is actually basically sells a lot of cars, either used cars. I've actually bought my old car from this website. So you get old cars, you get new cars, and so on. And as you can see, the overall headlines about this company is trading at least 17% below our estimates of its fair value. Earnings are forecasted to grow about 10% per year, which is quite nice. Earnings have grown basically 4.7% per year over the last 5 years, which is good to see that. Okay, trading, even though during COVID time it was still actually made it all right. They made it through. Trading at good value compared to peers in the industry, and analysts in good agreement that basically stock price will rise by at least 20%, which is quite nice. So let's have a look at here. So we got the market cap, which is 4.8 billion pounds. We had wide economic moat from Morningstar. Price right now is £5.20. Dividend yield of 1.7. Payout ratio only 29%, which is fine. And dividend streak is about 7+ years. Okay, because this company does not. This website does not actually give you in that sort of information. They have been increasing their dividend for basically, they've been paying dividend for 7 years. Okay, so but they have, for the 7 years they paid, they actually increased it. Is it stable? According to this website, it's actually not stable. Okay, profit stable basically means are they actually increasing every single year? Is it also safe? Okay, does that mean that they're going to cut it next year or year after? So basically the safety side of it is not apparently safe. They can cut it anytime soon. Okay, and a lot of the UK companies are not be honest, do that kind of thing. Okay, some have been increasing like Unilever's and so on, but they do cut a lot. Profit margin, okay, we're looking at about 51%, let's say. Free cash flow of 261 million pounds in the bank, so that covers enough, I think, the dividend. Total return in the last 5 years, so I put star there because we're talking about 5 years, we're not talking about 10 years. Okay, so 5 years we're basically looking about 4.52%, and this comes from Morningstar. And the forecasted annual earnings growth of 1 to 3 years of 10%, which is actually quite decent. And then 18% undervalued at the moment, and fairly valued, base fair value should be about £6.34. Right now we're looking about 5 something. Okay, right, so that's the first company. The next one is next, and the next one is next, right? So this is a retail shop. I'm sure you all know it. This is why where I buy a lot of my suits and so on that I wear to work. Currently trading market cap of 7.4 billion pounds. It has a narrow economic moat. Price right now is just about 60 pounds, if you like. 3.60 dividend yield. Payout ratio, we're looking about 30, almost to 40% if you come. Okay, 10 years of increasing that dividend. Is it stable? No. Profit margin about 15%. They have 404 million pounds in the bank if they want to, and the last 5 years they have actually made a return of about 5% to shareholders. And growth side of it, next year they're expecting a decline. Okay, I'm not sure why that is the case, but 26% undervalued at the moment. The price should be about 80. Okay, so basically not bad at all in terms of the expected growth. So you're making about 26%. Okay, on top of that you get about a couple of dividends. They have excellent free cash flow that covers the dividends, but the growth side of it apparently is not existing. Next one is Experian. Actually, in fact, let me show you the headlines for this company. So as you can see, is a retail clothing, footwear and home product in the United Kingdom, rest of the Europe and Middle East as well. Trading at 26% below our estimate of its fair value. Earnings growth grew basically about 22% over the past year. So that's probably why they're expecting a little bit of decline. Okay, so the earnings actually grew last year, which is very interesting. Maybe it's because everyone came out of lockdowns and start buying their product. I don't know, whatever it is. Trading at good value compared to peers as well. Okay, so analysts are saying earnings are forecasted to decline by an average of 3.4 per year for the next 3 years. Has a higher level of debt and a stable dividend track record. So these are some of the risks and these are some of the rewards if you were to buy that company. Okay, so the next company we're looking at Experian, and I'll show you the headlines as well. And this company is a technology company, is the company that checks your credits and so on. So you can sign up, I think it's about £12 if you are getting a mortgage and things like that. It's actually a good idea to check your credit ratings and so on. They actually help you. They tell you basically, I'm a member, so that's why I'm telling you. Okay, but yeah, look into it if you're interested in the company and but they are mainly technology company. They don't deal with the credit cards itself. Okay, they help you to understand what you are, basically where you are in terms of credit ratings and so on. Okay, currently trading at 4.9, just let's call it 5% below our estimates. Okay, fair value. Earnings are forecasted to grow about 13% per year, which is excellent. Okay, if you think about it, and some of the risk includes a high level of debt apparently. Okay, so that is what it is. Right, so market cap of 26 billion pounds. It has a wide economic moat. In terms of price, right now it's about £24. Okay, 28 pence, 1.6 dividend yield. Okay, payout ratio 38, which is quite nice, and 10 years of growing that dividend. They have a stable dividend. Okay, according to this website, and you can see it here. When we go down here, they have two things. So they have basically stable dividend, expanded per year, has been stable for the last 10 years, and payout has increased over the last 10 years, which is quite nice. So they have increased it, okay, 10 years plus, as well as it's actually stable. Profit margin of about 15%. Profit and free cash flow, we're looking at about $1.28 billion. That is, okay, I couldn't find it. So if you go in here, you will see free cash flow here will be basically shown in pounds. So 1.28 is basically what they have there. So total return in the last 10 years, according to Morningstar, is about 9%. Forecasted, like we've already seen, about 13%. I think 12.9%, but 13% if you round it up. And then is actually undervalued about 4%, 5%. Through basically £30.50 is where it should be. Right now it's this is where it is again. And basically this is one of the companies that I'm interested in, so I'm gonna look into it, see if it comes down a little bit more. Maybe if it comes down another 5% in the next few weeks or months, I might do a little bit more digging and find out a bit more information about the company, because it seems interesting in terms of their the market they are. But the issue will be, this will be cyclicals, because their business model is not something that's required. It's not like the Unilevers where we all go to the same supermarket and buy the same product every week. Okay, I have a subscription, but I actually recently thought about getting rid of it because I don't need a credit ratings right now, and I know what mine is and it's fine, so I'm going to get rid of that. That's £12 I can save and use for something else, energy bills and so on, right? So yeah, that's the only issue with this type of company. Okay, that's why I'm actually surprised it's not gone down a lot. Anyway, the next one is JD Sports. If you live in the UK, I'm 100% sure you've seen this. Growing up, this was my favorite place to go to, and where I spent a lot of my money, especially when I used to get my part-time job. Okay, do I do that anymore? Nope. I don't buy these kind of brand names, huge brand names. Okay, but yeah, they're a retailer, they're a great company, and their financials actually look surprisingly good. Let's have a look. Market cap of $7 billion. They have a narrow economic mode, currently trading at £1.35. Dividend yield 0.25. So they might as well stop it because that's non-existent. Okay, payout ratio only 2%. So they're using 2% of their net cash to pay off that dividend. Okay, so that's actually, they have a huge room to improve, I guess. They haven't increased that dividend, and it's not stable. Profit margin is very, very low. Free cash flow, they have basically almost closer to 600 million, which is quite nice, right? They have more cash than these actually bigger companies, if you think about. In fact, they actually market cap wise, these two. Okay, this is the same. But yeah, so they have a quite bit of a cash. Total return last 5 years, we're looking at about 5%. Forecasted about 11.6%, which is quite nice. And apparently it's down 69%. It should be trading about £4.38. That's very, very interesting. And if we look at simply Wall Street, you can see obviously is a retailer that sells all the brand names, clothing, footwear, accessories, and equipment for kids, women, and men, and all that stuff, right? But when you look at the trading at 69% below the fair, it is fair valued, and earnings are forecasted to grow. That is very interesting. But there, some of the risk is large one-off items impacting financial results. Okay, and profit margins are very, very low, just like what we've seen now. Okay, so that will be one of my concerns in terms of profit margins and so on. But it's trading very cheaply right now. Next company we look at is Croda International. This company is actually one of the companies I nearly bought about a year ago, and I didn't because at the time I was trying to understand the business model, and it's a little bit complicated. So what they do is they work with a lot of companies, including Unilever. So all the chemicals, the specialty chemicals in Europe. So what they do is a lot of their products is actually used to make all the shampoo, all the stuff that Unilever and other companies make. Okay, so and they are based in the UK, but they are in Europe and in America and all other countries. Okay, price to earnings ratio of 13.1 is below the UK's market, which is actually 13.4. Earnings grew basically 188 over the past just year, which is ridiculous. Analysts in good agreement that stocks will rise by about 20%. Okay, earnings are forecasted to decline by an average of almost 10% per year for the next 3 years. So every single year is going to decline about 10%, the earnings. Okay, and the high level of non-cash earnings is also basically one of the risks that they have. Okay, so $9.3 billion pounds of market cap is a narrow economic mode. 60, let's call it 67 pounds per share right now. 1.52 dividend yield, and 99 payout ratio is 99%. And that is something that I thought, okay, this is ridiculous. If you look at the earnings payout to shareholders, is just about 20%. Okay, but when it comes to cash payout, so this is the money that we receive if you hold this, is 99%. Okay, with this high cash pay ratio, dividend payment are not well covered by the cash flows. So if it's not covered by the cash flow, what the hell then? What's the point of paying a dividend? Okay, and they don't have a lot of cash in the bank, so they only have 145 million. Okay, but profit margin looks good. The dividend, according to even this website, after all of that, is actually stable. And obviously, like we've seen already, the earnings are expected to decline. 22% overvalued as well. $55 per pound is where it should be right now. So there you have it. That's 5 different companies. I actually was interested in Crowder for a while. I wish I bought it last year. I could have sold it by now, but I'm not going to get into it now because of this. The only one that, like I said, I'm interested is in this one here, but I want to see where things go, because if things stay the way they are, especially in basically around the world, and I was watching a documentary yesterday about the recession all around the world. It looks like it's not going to get any better anytime soon. And if that's the case, this type of companies that sell products that are not essential, will potentially suffer. Now, if the company is actually good financially, right, they could potentially be a good buy in the next couple of years. And when basically the world realizes we are no longer in recession, then this type of company will do well. So anyway, they have other products other than just credit rating side of things. If you're interested, maybe just do a little bit more research. That's definitely what I'm going to do. There you have it, 5 different companies that you've asked me to look into. And inshallah, I hope you enjoy it. If you have, please like the video, subscribe to the channel. But before I finish, I want to show you from Sharia side of things. Okay, let me zoom in so you can see it clearly. Okay, every single one of these companies is actually good. The only one that has a very high level there is the Next and JD. Okay, these 2 retail companies do have a very high interest bearing debt, but the rest of them are actually okay. So if you were interested, then Sharia compliance side of it, things are okay. Companies look decent enough. Look into it. Let me know if you have any questions. Assalamu Alaikum.